Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name's Richard Diaz and welcome back to the IceCap Canadian Market Wrap. Over the last few months, we've been warning that Canadian inflation was set to head higher. Last month, we focused on how the GST holiday gimmick would reverse itself, but we also talked about how higher producer prices due to a weak loonie had the potential to lift inflation back above the Bank of Canada's target range. We argued that this inflation rebound would complicate things for the BOC, and that's exactly what's happened. However, this week's video is not a victory lap. One data point is not enough to confirm a trend. So instead, we'll go over the data, review our prediction, how we might be wrong, and what it means for the BOC and interest rates. So let's jump right in. Canadian headline inflation rose to 2.6% year-on-year, or 1.1 month-over-month in February. This is within the target control range, but it was much higher than expected. Those expectations are based on consensus estimates from a bunch of economists, and the fact that data came in much higher than expected is really significant. With most financial market and economic data, what matters is expectations versus reality. So for inflation to come in hot, as we say in the business, it's meaningful. A breakdown of the major CPI components highlights the rebound from the GST holiday. And as a reminder, this gimmick was paid for by government borrowing to face down what the then finance minister described as a vibe session. But to quote an old adage, there is no free lunch. The issue now is that reinstating the tax means that inflation has reaccelerated. This should come as no surprise. If removing taxes lowers prices, adding a tax increases prices. The question now is, what next? But before we tackle that question, let's take a look at other measures of inflation. And to that end, we start with core inflation, or headline X food and energy, two parts of the index that can be extremely volatile. By removing them, we get a better feel for what's happening. And again, it's not good. Core inflation rose a fair bit, 0.5% on the month, up to 2.7%. A further breakdown of goods and services is also important because of the different inputs that drive their movement. Services tend to be stickier because they are more exposed to the labor market. Note that we're back up to 3.6%. Something to keep an eye on going forward. For goods inflation, we know it jumped in part because of the unwind of the GST break, but it's also worth noting that the goods index is at the mercy of energy prices. This is important because of the carbon tax that may or may not come. Who knows? One of my favorites is actually three. They're the BOC's preferred measures of core inflation. And here again, we have something interesting to flag. All three measures rose on a year-on-year basis, again beating estimates. And as a reminder, these three indices are designed to exclude transitory items. That is to say, they exclude the most volatile parts of your consumption basket. They are the central tendency of inflation and should not be ignored. This is critical because if you look carefully, these series all bottomed late last year and are steadily rising, even as the BOC cut rates. More on that in a minute. So what's going to happen next? Well, the truth is it's hard to tell. Obviously, the self-imposed retaliatory tariffs on U.S. products will raise prices for a multitude of goods that we import from America. However, that would be known as a one-off shock, and it doesn't tell us much about the future trend of inflation. Enter the IceCap inflation model, and so far, so good. It predicted the bottom of core inflation, and clearly input prices are rising fast, and a very weak loonie won't help. But we have to be careful going forward, as the tariffs will no doubt muddy the water. So what about the Bank of Canada? Well, as inflation fell, the BOC was quite self-congratulatory, and were desperate to bail out homeowners, lower mortgage rates, and reduce debt service charges. They cut interest rates at a record pace. This now seems totally premature. It also now puts them in a jam. They want to lower rates to support the economy, but they can't. Or rather, if they do lower rates, it'll put even more pressure on the loonie, which sits at a 20-year low. This is because there is a limit on the interest rate differential between the U.S. and Canada. In America, inflation and interest rates remain sticky, and the BOC cannot deviate too much from the Fed without having serious repercussions on the loonie. The reality is, for the BOC, this rebound in inflation could not have come at a worse time. So where and why could we be wrong? In the last video we discussed inflation, we touched on the unwind of the insane population growth from inflation, circa 2021 to 2023, and how it would pull down the CPI rent component. All of that is still a risk to our view. In truth, rent growth is probably much lower than the official numbers. Also, lower population growth means less demand, and at the margin, that means lower inflation. There's another important point that has revealed itself, and that's very weak consumer confidence. Fear is the mind killer. It's also horrible for consumption and demand, and you guessed it, inflation. If everyone in Canada stops spending, well, there will not be enough demand pressure on prices or demand-led inflation pressure. But I will caution that the opposite is also true. If there is some kind of resolution to the trade war, then confidence will likely snap back, and so will the inflation pressure. We shall see. All right, that's a wrap on this week's episode. Thanks very much for listening. Please like, subscribe, and follow for more. And as always, we manage money for families all around the world and Canada, so please feel free to get in touch.